the day gold lost its power, and the world never recovered for most of human history. Money was not an idea. It was a thing you could hold, weigh, and test. Money was gold. Long before banks, before governments, before modern states, gold earned trust because it was scarce. It could not be created by decree. It had to be dug out of the earth, refined by fire, and transported at real cost. That difficulty gave it power. From ancient Egypt to Rome, from China to medieval Europe, gold became the universal measure of value, not because rulers declared it so, but because societies independently arrived at the same conclusion. Gold did not rust. It did not decay. It could be divided, stored, and recognized across borders. A Roman coin minted 2,000 years ago still holds value today. That permanence is what made gold different from every other form of money humanity tried. Paper money came much later, and it was never meant to replace gold. It was meant to represent it. In China during the Tang and Song dynasties, paper notes emerged as warehouse receipts, claims on metal stored elsewhere. In Europe, goldsmiths issued receipts in the 1600s, promising the bearer a specific amount of gold on demand. The paper itself was worthless. The promise behind it was everything. This idea carried forward into the modern age. When the United States passed the Coinage Act of 1792, it defined the dollar as a fixed weight of gold and silver. The value of money was written into law as metal, not numbers. Even during crises, the gold standard imposed discipline. Governments could not simply print their way out of trouble. If they overspent, gold left the country. That loss created immediate consequences. Inflation, when it happened, was slow and visible. After the Napoleonic Wars, Britain experienced inflation and debt, but it was forced to return to gold in 1821 to restore trust. The pain was real, but contained. There were limits, and everyone knew where those limits were. Those limits mattered. During the late 19th century, when the United States debated abandoning gold, the argument was fierce because people understood what was at stake. Gold restrained power. It punished dishonesty. It forced governments to choose between war, welfare, or stability, never all three at once. Trust came from scarcity, not authority. A gold coin did not need a speech, a law, or a central bank to justify its value. Its worth existed independently of who was in charge. That is why gold-based systems survived revolutions, regime changes, and collapses of empires. Kings fell, flags changed, gold remained. Money, in this world, had weight. It had consequences. Every new coin meant effort. Every expansion had a cost. Growth was slower, but failures were smaller. Crises burned out instead of spreading endlessly. This was not a perfect system. It could be harsh. Recessions were painful. Adjustments were unavoidable. But the rules were clear, and the limits were real. And then, in the 20th century, humanity began to see those limits as a problem. Gold no longer felt like protection. It felt like a constraint. What came next would redefine money forever. In 1945, the world was exhausted. Cities were rubble. Economies were shattered. Trust was gone. 2 world wars had proven one thing clearly. Without a stable monetary system, peace could not last. Nations needed rules, predictability, a way to rebuild without repeating the chaos that had fueled global collapse in the 1930s. So in July 1944, while the war was still raging, representatives from 44 countries gathered in a quiet resort town in New Hampshire. The place was called Bretton Woods. The goal was nothing less than rebuilding the financial order of the world. What emerged was the Bretton Woods system. It was presented as a solution. In reality, it was a compromise. Gold was still there, but no longer for everyone. Under the new system, only one currency would be directly convertible into gold. That currency was the US dollar. The price was fixed at $35 per ounce. Every other major currency would be pegged to the dollar instead of gold. In theory, this preserved stability. In practice, it concentrated power. The United States was uniquely positioned to make this work. By the end of World War II, it held nearly 2/3 of the world's gold reserves. Its factories were intact, its infrastructure untouched. Europe and Asia needed American capital, American goods, and American protection. Trust followed power. The dollar became the center of gravity. If a country wanted to trade, it needed dollars. If it wanted stability, it held dollars. If it wanted gold, it had to go through Washington. For a time, it worked. The post-war decades became known as a golden age of growth. International trade expanded rapidly. exchange rates were stable, inflation was low, governments could plan years ahead without fearing sudden currency collapse. To the public, the system looked solid, permanent, even, but the stability was not natural, it was engineered. The system depended on one fragile assumption, that the United States would always have enough gold to back the dollars it issued. As long as the world trusted that promise, the illusion held. And it was an illusion, because while other countries were constrained by dollar reserves, the United States was not. It could issue the very currency everyone else needed. Each new dollar created a broad increased global liquidity, but also increased pressure on American gold reserves. At first, this pressure was invisible. Dollars flowed out to rebuild Europe through the Marshall Plan. They financed global trade. They supported military alliances. The dollar became more than money. It became infrastructure. By the 1950s, global commerce ran on dollar trust rather than gold discipline. This was the quiet shift. Gold still existed, but it was no longer shared. The system gave the world stability, but it gave the United States privilege, a privilege no empire in history had ever held before. The ability to fund global leadership by issuing the world's reserve currency. As long as confidence remained, the system looked flawless. Growth felt effortless. Crises seemed manageable. The past appeared defeated. But beneath the surface, a structural imbalance was growing. The world was building on dollars, and dollars were multiplying faster than gold. The golden age felt permanent. It wasn't. The very design that created stability also planted the seeds of its collapse. By the late 1950s, the balance was shifting. Quietly at first, then unmistakably. The United States had emerged from World War II as the anchor of the global system. But anchors are only stable if they stay heavy. In the decades that followed, American commitments multiplied. Military bases spread across continents. Alliances expanded. A permanent global presence replaced wartime mobilization. Then came war again. In the 1960s, the Vietnam War accelerated U.S. spending on an unprecedented scale. At the same time, domestic programs expanded rapidly under the Great Society: healthcare, welfare, education, infrastructure. The goals were political, social, and strategic. The funding mechanism was simple: print dollars. Because under the Bretton Woods system, the United States was the only country allowed to do this without immediate penalty. Other nations needed to earn or borrow dollars. America could create them. Those dollars did not stay home. They flowed outward through military spending, foreign aid, trade deficits, and overseas investment. By the early 1960s, there were far more dollars circulating outside the United States than inside it. This created a mathematical problem. Gold reserves did not grow. Dollars did. At the official price of $35 per ounce, the U.S. gold stock could not possibly cover every dollar now held abroad. The system depended entirely on confidence, the belief that not everyone would ask for gold at the same time. And confidence is fragile. Foreign governments began to notice the imbalance. Central banks ran the numbers. The promise was still legal. The gold was still there, but the ratio was no longer believable. No one wanted to be last. In Europe, doubts hardened into action. In the mid-1960s, Charles de Gaulle openly criticized the system. He called it unfair, dangerous, a privilege that allowed the United States to live beyond its means while exporting inflation to the rest of the world. France began converting dollars into gold. Ships crossed the Atlantic carrying U.S. gold bars to the vaults of the France. Other countries quietly followed. Germany, Switzerland, even allies began hedging their exposure. Each conversion reduced U.S. gold reserves. Each reduction weakened confidence further. Washington tried to contain the damage. Gold pools were created to stabilize prices. Diplomatic pressure was applied to discourage conversions. Temporary fixes replaced structural solutions. But the underlying problem remained unchanged. The United States was running persistent deficits. Dollars continued to flood the global economy. Gold remained finite. The gap widened every year. By the late 1960s, the illusion of stability was cracking. Markets sensed it. Governments calculated it. Central banks prepared for it. Yet to the public, nothing seemed wrong. Trade continued. Growth persisted. The dollar still ruled global finance. On the surface, the system looked intact. That was the danger, because confidence rarely collapses gradually. It holds, and then it breaks. By 1971, the United States faced a choice it could no longer postpone. maintain the promise and accept severe economic contraction, or abandon the promise and change money forever. The world was still using gold-based language, but it was no longer playing by gold-based rules. The system had not failed yet, but it was no longer stable. By the summer of 1971, the system was no longer fragile. It was broken. The numbers did not argue anymore. They accused. For years, the United States had promised the world that every dollar held by foreign governments could be exchanged for gold at $35 an ounce. But by now, the math was impossible. There were far more dollars in circulation than there was gold in US vaults. Not slightly more, several times more. Gold reserves were draining at an alarming rate. In 1958, the United States held over 20,000 metric tons of gold. By 1971, that figure had been cut nearly in half. Every month, more foreign central banks quietly lined up to convert their dollars while they still could. This was the danger point of every gold-based system in history. When trust turns into urgency. Inside Washington, the situation was understood clearly. Advisors warned that if conversions continued, the United States would lose its remaining gold within months. The promise that anchored the global monetary system would collapse publicly, chaotically, and irreversibly. At the center of this crisis stood Richard Nixon. Nixon did not create the problem, but he inherited it at its most dangerous moment. Inflation was rising. Unemployment was politically unacceptable. Pain could be delayed. Consequences could be postponed. Every problem appeared solvable with enough liquidity, but every solution came at a cost. By removing gold, the world removed the final limit, and once limits disappeared, growth no longer needed to be relit, only needed to be financed. What replaced gold was not stability, it was management, and once the system learned to survive without restraint, there was no going back. The rules of money had changed, and the world was only beginning to understand what that meant. When gold disappeared, something fundamental went with it, the limit. Gold had been more than money. It was a boundary. It forced governments to stop, to pause, to accept pain instead of postponing it. Without gold, that boundary vanished. For the first time in history, money could be created without a physical cost. No mining, no refining, no constraint beyond policy decisions. Problems that once required sacrifice now required printing. Recessions changed first. Before 1971, downturns were brutal but corrective. Bad investments failed. Excess was burned off. Recovery came slowly, but it was real. After gold, recessions became something to be managed, not endured. Interest rates were cut. Liquidity was injected. Pain was softened. And because pain was softened, lessons were delayed. Governments learned that every slowdown could be met with stimulus. Every crisis could be answered with spending. Deficits no longer triggered alarm. They became tools. What had once been emergency borrowing turned into standard practice. Debt stopped being temporary. It became structural. In the decades after gold, government debt climbed in almost every major economy, regardless of political ideology or growth rates. Surpluses became rare. Balanced budgets became theoretical. The system adapted to constant borrowing as if it were normal, because without gold, nothing forced it to stop. Financial crises followed the same pattern. Instead of being rare breakdowns, they became recurring events. The 1987 crash, the Asian financial crisis, the dot-com bubble, the global financial crisis of 2008, the pandemic shock, each one larger, each one answered the same way. More money, lower rates, bigger interventions. What was learned was dangerous. Markets learned that collapse would be cushioned. Banks learned that failure could be absorbed. Investors learned that risk-taking would be rewarded if it was large enough. This was not a conspiracy. It was an incentive structure. Asset bubbles were no longer accidents. They were features. Cheap money flowed into stocks, real estate, and speculative assets because it had nowhere else to go. Returns were pulled forward from the future. Prices disconnected from fundamentals. When bubbles burst, the response was not restraint but rescued. Each rescue made the next bubble larger. This created a strange kind of stability. Not balance, but suspension. The system no longer corrected itself naturally. It was held together by constant adjustment. Central banks became firefighters who never left the station. Interest rates stopped being signals. They became tools. Markets stopped pricing risk independently. They began pricing policy reactions instead. Stability was no longer organic. It was engineered, and engineering requires constant maintenance. Without gold, money no longer ended cycles. It extended them. Growth was stretched. decline was delayed. Weakness was hidden under liquidity. The system stayed upright, but only because it was being actively supported. This is why stability never returned, not because the system failed, but because it learned how to survive without fixing itself. Every intervention solved the immediate problem while making the long-term structure more fragile. Every crisis expanded the system instead of resetting it. The result was a world that looked stable on the surface, but depended entirely on continuous control beneath it. The absence of gold did not create chaos, it created dependence. Dependence on debt, dependence on policy, dependence on confidence, and confidence, unlike gold, cannot be measured, weighed, or stored. It must be constantly defended. This is the modern monetary world, stable enough to continue, too unstable to stop. The world today still runs on a decision made in 1971. Most people don't see it, but they feel it every day. Inflation is the first signal, not the sudden kind that shocks headlines, but the slow erosion that never fully stops. Prices rise, savings lose power, wages struggle to keep up. This isn't a temporary malfunction. It is the natural outcome of a system where money expands faster than real production. Before 1971, inflation was restrained by gold. After 1971, it became a permanent background condition. Housing tells the same story. Real estate no longer moves on population growth alone. It moves on interest rates. When money is cheap, prices surge. When rates rise, markets freeze. Homes transform from places to live into financial instruments. Entire generations are priced out, not by scarcity of land, but by abundance of liquidity. The stock market follows a similar pattern. Valuations stretch far beyond historical norms, not because companies suddenly became more productive, but because money became cheaper. Future earnings are pulled into the present. Risk is tolerated because liquidity is expected. Prices rise, not on balance, but on belief. And when belief breaks, something unusual happens. Failure no longer clears the system. In earlier eras, bad investments failed and disappeared. After gold, failure became unacceptable. Banks were rescued, corporations were stabilized, markets were supported. The logic was always the same. Letting failure spread would threaten the entire system, so bailouts replaced collapse. This reached its peak during the 2008 financial crisis. When global banks teetered, governments and central banks intervened on a scale never seen before. Trillions were created to prevent a reset. The system survived, but it learned a lesson. It learned that it would be saved. That lesson reshaped behavior everywhere. Financial institutions grew larger, risk concentrated. Markets stopped fearing collapse and started expecting rescue. This wasn't guaranteed by law. It was guaranteed by precedent. Markets no longer survive through correction. They survive through expansion. Every crisis leads to larger balance sheets, deeper intervention, and greater dependence on central management. The system grows not by resolving weakness, but by absorbing it. Trust, in this world, is no longer rooted in value. It is enforced by policy. Currencies are trusted because central banks defend them. Markets are trusted because authorities backstop them. Stability is not earned, it is maintained. Confidence does not come from scarcity, but from assurance. At the center of this structure stands the Federal Reserve and its global counterparts. Their role is no longer limited to inflation control. They now manage liquidity, asset prices, and expectations. They are the system's stabilizers of last resort. And this changes how people think. Investors watch policy statements more closely than balance sheets. Markets react to speeches instead of fundamentals. The future is priced not on productivity, but on intervention. Each crisis confirms the pattern. After 2008 came years of ultra-low interest rates. After market volatility came quantitative easing. After the pandemic came unprecedented monetary expansion. Each response was larger than the last, and the system adapted again. This is why the world feels permanently unstable, yet never fully collapses. Why bubbles form faster. Why recoveries feel artificial. Why debt grows faster than growth. Why confidence must be constantly reassured. The system we live in now is not broken. It is functioning exactly as designed. A system without gold cannot reset naturally. It can only expand, manage, and postpone. And after every crisis, it emerges bigger than before, more complex, more indebted, more dependent on control. This is the modern monetary world, not balanced, not anchored, but sustained by belief, by policy, and by the constant promise that it will not be allowed to fail. Until one day, That promise is tested. There is no road back. The world crossed a line in 1971, and that line does not allow reversals. Money cannot be tied back to gold without collapsing the structure built on top of it. The debt is too large. The system is too interconnected. The promises are too many. Any attempt to return to pre-1971 money would not restore stability, would destroy it. So the future does not involve going back. It involves going forward, deeper into the system we already live in. Crises will not end this system. They will feed it. Every shock justifies expansion. Every emergency creates permission. Each time markets freeze or economies stall, the response is the same. More liquidity, more debt, more intervention. What once felt extraordinary is now routine. What was once unthinkable is now expected. The system has learned that fear is fuel. Debt will continue to grow faster than productivity, not because leaders are reckless, but because the structure demands it. Growth now relies on borrowing from the future. Without expansion, the system tightens. Tightening risks collapse, so expansion becomes the safer choice. This creates a one-way path. Debt cannot shrink without pain. Pain is politically unacceptable, so debt grows. Productivity cannot keep up with financial claims. Real output moves slowly. Financial numbers move instantly. The gap widens every year. The system does not correct it. It manages it. This is where alternatives enter the picture. Gold never disappeared. It simply stepped aside. Its resurgence in times of uncertainty is not nostalgia, it is signal. It reflects a quiet doubt about limitless promises. The same is true for digital assets and decentralized money experiments. They are not revolutions. They are symptoms. They represent mistrust. Not necessarily mistrust of governments, but mistrust of permanence, of restraint, of discipline. People look for assets that cannot be printed, because printing has become the default response to every problem. These alternatives will rise and fall. Some will fail. Some will survive. But none of them are likely to replace the system. They exist alongside it, not above it. Because the system does not survive on health. It survives by design. It is engineered to absorb shock, delay consequences, and redistribute stress across time. Weakness is not eliminated. It is spread. Failure is not allowed to concentrate. It is diluted. Collapse is avoided not by balance, but by intervention. This is why the system feels both fragile and unstoppable. It cannot heal itself, but it can sustain itself. Control becomes the central theme of the future. Control of liquidity, control of rates, control of expectations, control of behavior. Money becomes less about exchange and more about management, not just of markets, but of responses. The question is no longer whether money is real, it is whether money is obedient. As systems grow more complex, transparency decreases, decisions move further from the public eye, emergency measures become permanent frameworks, temporary tools turn into standing mechanisms. None of this requires conspiracy. It requires momentum. A system without limits does not stop on its own. It continues until something forces it to change. That force may not be collapse. It may be reconfiguration, more rules, more oversight, more control in exchange for stability. The future of money is not a return to gold. It is not a sudden reset. It is not a clean break. It is a slow tightening of management over a system too large to fail and too fragile to trust itself. The world after gold learned how to survive without anchors. Now it must learn how to survive without freedom from intervention. That is the real question ahead. Not whether the system will collapse, but how much control it will require to keep going, and who gets to decide where that line is drawn. Gold didn't lose its power, it was politely pushed aside. Money lost its anchor, then congratulated itself for finally being flexible. Limits vanished. Discipline followed, and debt stepped in, wearing the mask of progress. The system didn't collapse. It evolved into something endlessly managed, permanently fragile, and confidently unstable. And that's the irony. The world didn't fall apart when money broke free. It simply learned how to live without ever truly recovering.